Polygon just finished the acquisition of CoinMe and Sequence, but still, even post-acquisition, it is pricing two very different futures. In one path, Polygon will remain trapped between 10 cents and 20 cents. It'll continue to be treated as a background utility token, even after these major strategic changes. But on the other hand, Polygon could begin repricing upwards to 75 cents to $1.20, not as a layer 2 asset, but as a regulated payment infrastructure. So what decides between these outcomes is not sentiment, not adoption headlines or narratives. It is whether Polygon's newly acquired payment stack of Sequence and CoinMe actually helps them capture value on chain, or will it leak somewhere else? Guys, this mechanical distinction is what we are going to be breaking down today. We are going to be looking at Polygon and the 2026 price outlook, taking into account the two new acquisitions, the $250 million acquisitions of CoinMe and Sequence. So guys, before we go any further, this framing matters. Every price range in this video is going to assume Polygon after the CoinMe and Sequence acquisitions, not the Polygon most models are still referencing. Because guys, this is no longer a layer 2 valuation problem. It is now a payment infrastructure, adoption, utility, and valuation issue. The question has become whether Polygon remains priced like a low-end utility token, or is it going to reprice and earn a higher order infrastructure multiple tied to regulated money flows. And that's the one structural detail most models are still ignoring, and it determines whether Polygon will ever escape the sub 50 cent pricing. Do the CoinMe and the Sequence acquisitions finally help it break out and finally let the market look at Polygon as more than just another layer 2? But we'll get there. So let's anchor the neutral 2026 baseline post-acquisition. Even with CoinMe and Sequence fully integrated, Polygon can remain range-bound between 25 and 40 cents. This range reflects growing payment volume, functional wallet infrastructure, early stage revenue contribution, incomplete token level capture. But what keeps Polygon trapped here? Payments settling without sustained burn pressure. Revenue captured at the application layer. Polygon being used primarily as settlement fuel, not economic rent. And critically, what does not move Polygon out of this range? More users, more partnerships, more transaction throughput. If we see those things, it doesn't really matter. It's going to stay range bound. Because without structural capture, even post-acquisition growth does not force a repricing. So why does the growth not equal a repricing of the asset? This is where the pre-acquisition versus post-acquisition distinction matters. Before the CoinMe and Sequence deals, Polygon's problem was structural. Usage expanded, but value consistently exited the system. That's why Polygon spent years trading in the 10 to 30 cent band, despite having strong fundamentals. The 2026 pivot, though, is not about increasing usage. It is about closing value leakage. Until payment flows are structurally forced to touch Polygon through burn, lockup, or routing constraints, the token behaves like a commodity input. That dynamic alone can keep Polygon suppressed near the 20 to 30 cent level, even if we say the year was a success. So let's talk architecture shift and the mid-range setup. This is where the acquisitions start to matter mechanically. With CoinMe, Polygon now controls regulated fiat on-ramps across, I think, 49 US jurisdictions. With Sequence, it controls wallet-level routing and UX abstraction. Together, they form what people are referring to as the open money stack. Not a chain, but a complete payment system. That architecture introduces a defensible mid-range price band of 45 to 70 cents if three conditions hold. Number one, payment volume consistently settles on Polygon infrastructure. Number two, Polygon is required, directly or indirectly, for final settlement or burn. And number 3, value capture occurs at the protocol layer, not just the application layer. But what caps Polygon below 70 cents in this scenario? Well, that would be stablecoins doing most of the economic work, Polygon remaining optional rather than enforced, and burns offsetting issuance but not dominating it. Guys, this range represents the partial monetization, not full infrastructure repricing. So now let's talk our upper case, okay, the upper bound where we want it to go. This is the high end 2026 outcome post acquisition. And we're saying this range is going to be 90 cents to $1.20, right? And this price only becomes defensible if Polygon is repriced as a regulated financial infrastructure, not simply blockchain middleware. That requires alignment across 3 conditions. CoinMe-driven payment volume scales meaningfully. Sequence wallets structurally route value through Polygon rails. Polygon burn or lock mechanisms accelerate faster than issuance. Guys, at that point, Polygon stops trading like throughput and it starts trading like settlement ownership. But guys, this outcome's not automatic, right? These are big companies. The acquisitions were $250 million. So we need to start looking at these as companies, not simply tokens on a blockchain. Because like I said, it's not automatic. It's not guaranteed, and it's not narrative driven. It will be earned through enforced value capture. But now that we've talked about the upside, we have to talk about the risks, right? Let's re-anchor the downside risk even post-acquisition. If payment flows behave like pass-through volume, Polygon can still revisit 8 cents to 15 cents, regardless of the quality of the infrastructure. Why is that? Dilution from incentives, competitive settlement layers, stablecoins capturing economics, payments becoming commoditized. Again, strong fundamentals do not guarantee strong price action. They only create optional upside, not certainty. So guys, the final price map post-acquisition of CoinMe and Sequence for Polygon. Here is what we're looking at. 8 cents to 20 cents, value leakage or stagnation. 25 cents to 40 cents, functional growth, weak capture. 45 to 70 cents, partial monetization of payments. This is where the acquisitions start kicking in and creating synergies. And 90 cents to $1.20, full infrastructure repricing. Polygon's future is no longer about winning the layer 2 wars. It is about whether regulated money flows are structurally forced to settle through the stack Polygon now owns, from fiat entry to wallet routing to final settlement. Guys, in the next episode, we will track the single metric that matters the most, Polygon burn per dollar of CoinMe payment volume, and whether it's rising fast enough to justify a higher price. Guys, that's the signal, not sentiment. That's what's going to decide the outcome. This is Ledger Prime, and we'll see you in the next one.